At the weekly chart, at the weekly chart also, I hope that these bright levels doesn't prevent you from having a look at this yellow line. This line is 200-week moving average, and you can see that for 2 weeks in a row, this line, which is located at 110.25, saved dollar yen from further declines. And this is why we should respect this support level greatly. Let's now have a look at the daily chart. Here I also have this indicator of the daily pivot levels, and you can see that the pair started this week above the weekly pivot mark located at 110.90, and the resistance levels we'll focus on are located at 111.72 and 112.39, together with 113.19. All in all, I think the level of 111.70 is very important, because in this area we find the lows of February, which were initially broken. Then there was an attempt to get higher, to return higher, but then the pair once again dives down. Geopolitical tension limits the US dollar's ability to increase versus Japanese yen. If we look at the economic data from Japan, they weren't particularly bright. The Bank of Japan's Tenkan quarterly business survey showed that the index for big manufacturer sentiment came in at 12 in March, failing to match the forecast of 14. At the same time, this geopolitical tension, the US missile strikes at an air base in Syria, provoked an increase in the market's risk aversion and consequently demand for the yen as a safe haven. US labor market figures were mixed and didn't provide a big boost for the US dollar here, but still helped the US currency to stay above the support line. So here we have a kind of controversial situation. On the one hand, the US dollar is surely stronger than Japanese yen. On the other hand, geopolitical tensions act as a bit of negative factor and don't let the greenback to get here in full force. So the upside potential is surely limited. I wouldn't expect the greenback to get much above 112.40, and 111.70 is also a hurdle for the US dollar. The pair is consolidating, and although upside levels are more likely, still there is not much to go on the upside. I also remember that there was an Ishimoku cloud important here at the weekly chart. Let's have a look at it. Probably I'll make the cloud a bit brighter so that you could see it better. Here it is, and we'll get rid of the pivot indicator. Now we'll see better the weekly picture. And here you can see that at 111.36 there is the top of the negative Ishimoku cloud. The pair has already entered this cloud, and this was surely a negative thing both for the US currency versus Japanese yen. There was a lower high formed on the weekly chart, and the pair fell below its minimums. Once again, the 200-week moving average represents a good support, and if there is a close of the weekly candle or a daily candle below the level of 110.30, 110.20 will turn more negative on dollar yen, and they will have inside the 50-day moving average, which is located at 108.24. For now, the picture looks better. There is potential for the upside, although you can see here as well with the daily Shimoku cloud this time that this potential is limited by levels which are above 113 mark. Although the fundamental picture for the pair is not very interesting, as we have very little on the Japanese side of things. So the main things fundamentally to focus on will be data from the United States, statements of the Federal Reserve's officials, and also the market's risk sentiment, which may increase demand for the yen. So be attentive, focus on these resistance and support levels in your trading.